Gold has long been seen as a marker of wealth and a reliable store of value. In recent times, its importance has been underscored by a record increase in pricing. On March 18, 2025, gold climbed above $3,000 for the first time as investors flocked to safe haven assets as fears of recessions mounted. There are a couple of reasons for this phenomenal growth in the demand for gold. Some of the uncertainty has been driven by geopolitics with heightened concerns about global stability following several recent events, including geopolitical uncertainty in the Middle East, prompting investors to shift to gold for financial protection. A weakening US dollar has made gold more attractive to those who hold other currencies, further driving demand. The fear of a global trade war and concurrent economic recession has driven people across the world to the safe haven of this precious metal as well. In this video, we will take a look at the factors driving the gold price to increase month after month and the political and economic forces behind this movement, so that you can decide if, in the current financial environment, gold will be a suitable investment or not. The gold price is up a lot, but it is not random. It is the result of a combination of economic, geopolitical, and market forces. These variables shape the demand for gold, something investors, governments, and central banks monitor carefully. Let's break down the key forces behind the rise in gold prices. Gold price is primarily driven by fundamentals of supply and demand. On the supply end, gold mining production is a major aspect. Conversely, if mining output decreases, whether from reserve drainage, inflexible environmental regulations, or geopolitical instability in major gold-producing countries such as China, Australia, or Russia, the supply of available gold may shrink, pushing the price up. New methods of gold extraction can impact the level of supply as well. On the demand side, various factors lead to increased prices of gold, be it industrial use, consumer behavior, or investment patterns. If demand for gold continues to rise, whether from greater industrial application, investor speculation, or central bank purchases, and supply is steady or dropping, the price is bound to rise. Interest rate changes issued by central banks have a huge effect on gold prices due to the impact they have on investor behavior. Usually, there is an inverse relationship between interest rates and gold prices. As interest rates go up, bonds, savings accounts, and other interest-bearing instruments with real returns become more attractive than a non-interest-bearing asset like gold, which doesn't provide significant return on investments. This reduces its demand, and therefore the price also falls. However, when the opportunity cost of holding gold declines as the interest rate comes down, it becomes a much better alternative. Simply put, demand increases for gold, which results in the price rising as investors flock to it as a store of value in such conditions. Central banks hold a large portion of the available gold reserve and influence the speculation with varying prices through their buying and selling actions, therefore making them an important player in the international gold market. An increase in total gold in central bank reserves is viewed as a show of confidence in gold as a valuable asset and tends to increase investor demand. Countries such as China, India, and Russia have been increasing their reserves to reflect that gold remains a safe haven asset during troubled times. However, when central banks sell their gold reserves, supply in the market will increase, causing the price of gold to fall. Through such actions and decisions, central banks not only affect prices in the short term, but also influence market sentiment in the long term and macroeconomic stability around the world. Geopolitical and global stability are also factors that drive gold prices, as investors look for safe haven assets in times of uncertainty. When political instability, wars, and trade restrictions occur, the financial markets become unstable, and investors begin moving their assets away from risky investments to gold. Geopolitical events like war in major gold-producing areas or sanctions on countries like China or Russia will affect mining operations and the supply chain, leading to a decrease in mine supply and an increase in price. Moreover, events such as the US and China trade dispute can also cause investor confidence to diminish, leading to higher demand for gold as a safe haven asset during turbulent market conditions. The overall state of the economy is one of the biggest factors affecting gold prices. When the economy stumbles, investors look for safer assets, and gold has long been deemed a trusted store of value. Demand for gold typically increases during financial crises, recessions, and political tensions as people seek safety during uncertain times. For example, during the 2008 financial crisis, the prices of gold soared high when stock markets tanked and currencies got weaker. Likewise, fears of a global recession or banking instability can drive investors towards gold, increasing the price as demand exceeds supply. The value of gold is closely correlated to the strength of the US dollar since it is quoted in USD on the international market. As the US dollar gains strength relative to other currencies, gold becomes more expensive for international buyers, therefore decreasing demand and price. This inverse relationship is a major reason why a strong dollar leads to falling gold prices. On the contrary, when the dollar weakens, gold becomes cheaper for buyers using other currencies, boosting demand and pushing prices higher. This factor plays a key role in the market fluctuation of gold, as exchange rates on currencies help drive investor decisions in particular countries where gold serves as a popular asset for wealth preservation. One of the main factors directly influencing gold price is inflation, as gold is considered a hedge against inflation and currency devaluation. When inflation rates rise, the value of paper currency decreases, and gold becomes a more appealing store of value. Therefore, investors buy gold in an attempt to protect their wealth from eroding under higher consumer prices and the declining stability of fiat currencies. This increase in demand leads to prices going up. On the other hand, in times of low inflation or deflation when currencies retain their value and investors feel no rush to procure gold, the demand decreases, thus lowering prices. Another important factor that directly impacts the gold market, especially in mining and processing, is technological advancement. New extraction technologies like chemical leaching and biomining techniques can help access gold deposits more easily and economically, leading to an increase in the supply. This will balance the demand and supply, reducing the price. Demand-wise, technological advancements in sectors such as aerodynamics, electronics, and medical devices continue to determine the demand for gold since it is an ideal conductor and resistant to corrosion. Technological advancement in these sectors can impact demand, either increasing or decreasing it, thus impacting the price of gold in the world market. Investor behavior and market speculation are two significant factors that influence gold prices. Speculators frequently base their gold purchases and sales on their projections of future price changes. This may result in short-term fluctuations in the market. While key factors influence long-term trends, short-term price movements are often driven by speculative trading. When the economy is struggling, for example in times of excessive inflation, investors usually look to gold to offset their losses. However, the question arises whether it will be advantageous to them and assist them in reaching their investment objectives. Let's break down the pros and cons of purchasing gold. Gold is a reliable investment. Generally speaking, demand for it rises during recessions, and there is historical evidence to back this claim up. According to Gold Silver, 6 of the 8 most significant stock market crashes in the past 40 years saw gold prices rise. It also performed really well during the recession in the late 2000s, when the S&P 500 index dropped to a rough 56.8%, with prices increasing by 25.5%. This reflects the fact that it is understandable why gold is seen as a safe haven and a hedge for many significant international markets. According to estimations from the World Gold Council, WGC, approximately 209,000 tons of gold, worth $12 trillion, have been extracted over the years. The WGC states that the asset is virtually indestructible and that almost all of it is still available in one form or another. Gold has been a valuable asset for thousands of years and continues to be so to this day. Furthermore, it is also a widely acknowledged asset, and overprinting does not devalue it, unlike fiat currency. It is also in demand while being scarce, and its value only increases when investor behavior is impacted by economic turmoil. Gold has a high level of liquidity, just like other important assets. This shows that buying and selling it is simple, particularly now that so many trustworthy platforms have emerged. There may be more alternatives for strategy since one can buy gold as exchange-traded funds, EFTs, futures, or physical metals. However, the one issue that investors may face is in regards to huge gold bars, as they can be more difficult to sell rapidly, causing liquidity problems. To address this issue, one can redeem gold bars through financial institutions that can provide flexibility when included in investment products. Additionally, gold retains its inherent worth even after endless recycling. This guarantees that a substantial amount of metal is left behind for trade, which makes it easier to buy or sell, even on the second-hand market. One of the most widely used strategies by investors to decrease risk is portfolio diversification. Gold is a key component of this strategy, as its value tends to increase when other investments, such as stocks or bonds, drop. This means gold is an appealing asset for investors looking to hedge their portfolios against volatility and downturns in the market. Ruhi Rathod, Director of Finance and Operations at Barry O'Neill, said gold's performance during economic uncertainty or amid a decline in financial markets helps it act as an offset against declines in other asset classes. Adding gold to a portfolio can lower overall risk, as it functions as a stabilizer for more speculative investment and helps preserve wealth in the long run. One of the most common ways to invest in the yellow metal is to purchase actual physical gold. However, bear in mind that doing so will cost you extra. To guard against damage or theft, you must have them insured and store them in a secure location such as a bank safety deposit box or a dedicated storage facility. But doing so results in significant costs that must be subtracted from your profits. In addition to this, transaction fees charged by dealers and brokers raise the total cost of gold ownership. A common option for investors wishing to efficiently purchase gold are government-issued bullion coins, which are distinguished by their purity and gold content. They are not the same as rare coins, which are prized for their historical significance and rarity rather than their gold content. Another alternative that can assist in reducing expenses is purchasing gold mining shares and other gold-backed paper assets. In contrast to certain investments that provide passive income, such as rental properties, certain equities, and bonds, physical gold does not offer interest, dividends, or passive income. When investing in gold, you won't be able to get a return unless you sell it. As a result, this kind of asset can eventually show a performance lag in an investor's portfolio. One should especially be mindful of this if they are the type of investor who depends on consistent sources of income for retirement planning or other obligations. Similar to other assets, gold is also at risk of price volatility, which means that its value can significantly fluctuate over a short period of time. Even though the price and value of gold has increased a lot in recent times, there is no guarantee that it will remain this way forever. Gold has always been a precious metal and a valuable asset, but its price is influenced by multiple factors, from market speculation to the central bank's policies and global economic uncertainty. Even though it can be a great barrier against inflation and a strong mechanism for portfolio diversification, its volatility also creates dangers. Therefore, the question of whether gold is still worth buying depends on your financial goals and risk tolerance. What are your thoughts on this? Let us know in the comments down below. If you want to watch more such content, don't forget to subscribe.